are in listen-only mode.
Well, good afternoon, everyone. My name's Rick Spooner. Welcome to this afternoon's webinar. I'm being assisted this afternoon by Ryan Schofield from Trade with Precision. Just a couple of housekeeping matters to make things easier for you. Feel absolutely free to ask questions as we go through. You can do that by typing them into either the question or chat box that you see on the platform. We'll endeavour to answer those either at the end, just to keep the flow going, or if it's appropriate as we go through. And depending on the nature of the question, I might try to answer some of them verbally, but others we can provide a typed answer to your typed question. So look, what this afternoon's webinar is about, or what I had in mind to talk about, was just to hone in on the business, if you like, of combining technical and fundamental analysis and using them in tandem. And so what I'm going to do is just to look at some basic approaches to doing that and some techniques, and to provide some examples of how you might go about that using some of the tools available on our platform. Obviously, fundamental analysis and technical analysis are in themselves huge subjects, and so it's not my intention this afternoon to go into depth into either of those ways of looking at markets, other than to provide some examples about it. So as I say, the key idea this afternoon is to just look at ways of gaining an edge, if you like, or improving, I think, the value of both forms of analysis by using them in combination. And the other thing I thought I would do to begin with is just to put all this in context by just making a few observations about the overall approach, or my overall approach in particular, to developing trading strategies, and some sort of broad observations about some things that I've found important to do, or that have worked and haven't worked. Before I get into it, though, I do need to just pause for a second or two to give you a chance to read this important information. One of the key things here, I think, just is that I, of course, don't know what your own situation is and what your objective and financial situation is, so I'm not in a position to provide you with specific advice, and what we're doing here is just talking very generally in educational terms, and it's up to you to decide whether anything that you hear today is appropriate to your own circumstances. All right, well, let me just begin then by just starting off with a few broader observations about strategy and trading strategy. Well, I guess one of the things is to just talk about the perennial debate, I guess, about whether fundamental analysis works or technical analysis works, or whether one's better than the other. It's a bit of a historical argument, I guess, in a lot of ways, and certainly I don't think you see nearly as much of it as you used to, but it wasn't, being a sort of a guy who's been around for a while, this used to be a kind of a tribal or almost religious issue between traders and investors, but particularly traders. And people were very passionate about believing that they were either technical analysts or fundamental analysts, and that the form they used worked and the other one definitely didn't. I'd love to have $1 for every kind of presentation or book that I've started reading where technical analysts in particular sort of pan fundamental analysis as being something that's a lot of subjective gobbledygook that doesn't work. But very much the opposite gets done as well. And I think a lot of that goes back probably to finance courses in university. If you've done one of those, which I'm sure a lot of listeners probably have, certainly that was my experience, that you did finance at university. You learned about a thing called the efficient market theory or hypothesis, and basically that held that the market was an efficient reflector of all known facts and knowledge, and the only thing that influenced the market was new or fresh circumstances and news, and that therefore anything which does what technical analysis purports to do, which is to make forecasts about future price movements based on what's happened in the past, was logically unsound and didn't apply. And so most people who did finance at university came out believing that technical analysis was, a lot of rubbish, and that sort of set up a prejudice. And I think it was true to say, possibly is still true to say to some extent, that a lot of technical analysts tend to be people who are more self-taught, and therefore have the opposite approach and are very suspicious of fundamentals. These days, however, I think it is far more common, particularly amongst institutionals and hedge traders and other portfolio investors, as well as private investors, to use both. And certainly that's been my experience. My own approach, I did come out of university thinking technical analysis was a lot of rubbish, and held that position for quite a few years, until at one stage I was lucky enough to work in a dealing room where there was a very good technical analyst, and basically I just really couldn't ignore the fact that used properly, it is a useful tool. And really, of course the efficient market hypothesis just doesn't pass the pub test, really. I mean, it's pretty obvious that markets do form patterns, and that you can, if used properly, make some useful observation about what's going to happen in the future based on those patterns. And of course, that's all about human behaviour, that markets are about more than information. They're about how humans react to information, which is really the logical underpinning of technical analysis. Both tools are imperfect, of course. I mean, neither of them work or are well and truly less than perfect, and have plenty of faults. And essentially, it's a matter of, with both forms of analysis, of coming up with strategies and grafting strategies onto them that give you a decent risk-reward outcome. And my own approach, which I guess the thing I've found to work best, which I think probably to some extent just reflects my own attitude towards markets and what I enjoy doing as well, but is that basically I for the main part, like to know something about value, about the trend, whether it's up or down, and about the momentum or the strength of that trend. Is it strong? Is it weak? Is it getting stronger? Is it getting weaker? And to sort of form a holistic picture of the asset that I'm trading based on those three things. Now, but I also don't like to overanalyze. I mean, essentially, there are lots and lots of different tools that can often do largely the same sort of thing, and it's a matter of just selecting a small number of tools, often only possibly one in each of those areas of value, trend, and momentum, that gives you an overall indication of what's going on, and then you can develop a set of trading rules around. So my own experience has been that with stocks anyway, that I have found that for me the best techniques are combining value with technical analysis, but also I have been able to make strategies based on technical analysis only work without any fundamentals, and especially in other asset classes like Forex and so forth. And at the end of the day, I think a lot of how you go about this is probably a question of what interests you, but also how much time you've got. Technical analysis is certainly useful if you don't have as much time, if you've got a day job as well as doing some trading, and once you've developed some strategies, it's a way of scanning out and looking across a lot of different markets and doing things a bit more efficiency. So it's just a matter of really where you fit in that sort of spectrum, I think, as to which approach you use, or whether you use a combination of both. With stocks, I think one of the things that I think is very important is to make a clear distinction between investing and trading. Most traders are probably also investors, although a lot of investors are not traders. But if you are trading, I think you need to be very clear about the difference between the two. And I think to completely separate them. You might end up owning a particular stock as part of both your investing and trading strategy, but I think it's a good idea to keep them totally separate, to have completely different pots of money that you apply to them. And the reason for that is that whilst there's a lot of crossover between the two activities, they do require different strategies, particularly trading. It is quite a different thing to investing, and where you get into trouble is where you start confusing the two and turning something that was a trading position into an investing position rather than taking a loss in it, or getting out of investment on a bit of a whim because you're doing a bit of trading with them. And that sort of intersection between the two of them is where it pays to be clear. And look, loosely speaking, I would define investing as something where I'm intending to own an asset for a long time. My intention is to own the asset, and for me to profit out of its earnings growth. That earnings growth might come in the form of dividend growth and or capital gain. And of course, I'll sell investments, when my own circumstances change, or when there are better opportunities, or the nature or risk profile or whatever of the investment asset changes. Trading, on the other hand, is about taking advantage of what you see as short-term mispricing, and buying something because it's cheap, selling it when it gets to fair value, and that sort of thing. And of course, with trading, you're doing a lot more. There's a lot more turnover, and the big thing about trading is that taking losses is a routine part of it, and that you need to really well and truly develop loss taking into your overall trading strategies. And indeed, I don't have time to talk about this in great depth today, but I think one of the core things for trading, and by the way, my intention today is to talk mainly about trading and not investing. But look, trading at the end of the day, whilst there's more to it than this, at the end of the day, if I want to make money over a year as a trader, to state the very obvious, it's a matter of making more profits than losses in terms of dollar value, and that in turn boils down to the combination of the percentage of winning trades compared to losing trades, in combination with how big my profits are compared to my losses. And there are those two ratios, often called your success ratio and your payoff ratio, and it's how they fit together that determines whether you make a loss or a profit over a year. One of them by themselves is not enough. You can well and truly, in fact, probably the typical profile of a losing trader is you can well and truly have more profits than losses over a year, but lose money because the size of your losses is larger than the size of your profits. Conversely, you can have much larger profits on average than losses, but not make money because you don't have enough profits compared to the number of losses you take. And I've found that there are basically sort of two basic approaches. One is to sort of concentrate on getting a high success ratio, that is a relatively high number of winning trades compared to losing trades, but doing so with a good enough payoff ratio to make money at the end of the day. And that is where you're sort of basically taking profits faster. So in terms of valuation and value type trading, that sort of approach is, this sort of thing I've got on the screen here, where you're buying when something is cheap and selling out at fair value, which is not too far away, and just hoping to do that kind of thing too routinely. But where you buy where it's cheap and it goes the wrong way, you're looking to stop yourself out fairly quickly, so that the size of your losses is still smaller than on average the size of your profits. The other approach, where you're looking to hit the ball out of the park, where you want to get involved with the Fortescues and CSLs and A2 milks and things, and really run trends and really make those big profits. And we've seen a lot of those in our market in the last 12 months or so. That's where you're focusing basically on the payoff ratio. You're probably going to have a lot more losses, but you want your success ratio to be good enough so that you still make good money overall by hooking onto some of those big trending markets and staying with them, making some big profits and not having and having probably quite a lot more losses, but not so many that you don't end up with a fairly good result at the end of the year. Lastly, in terms of overall approach, I just wanted to make a couple of observations about my own approach to technical analysis, which is after all a tool or a set of tools. And I guess what I should have said before is that I've never had much success myself with just using one thing. Can I make money out of moving averages, or can I make money out of an RSI or trend lines or whatever? I found that the better approach is to use them to form a tool, to form a picture of what's going on, and then to set some rules up about where I get in and out. And one of the really useful things I've found is to use technical analysis just to form a picture about what's going on in the market, because it's often, although not always the case, that markets are in one of the sorts of three phases that I've got here. You've either got trends going on, and sometimes you get these strong impulsive trends that I've got here, where markets move a long way vertically from down to up or up to down without taking much time across the horizontal axis of the chart. Usually though, not always, but usually trends correct. You have small counter trend movements against the overall trend. Excuse me. And a third characteristic of a market is what Charles Dow called accumulation and distribution patterns, which are often flat sort of behavior that occur at the top after a downtrend, which he called a distribution pattern, or an accumulation pattern. It's a flat pattern that occurred after a downtrend, where the smart buyers were accumulating from the late sellers. And the reason I mention all that is that trading, of course, as we've just discussed, is about risk and reward, is about balancing profit against loss. And there are a couple of, or two or three strategic points on a chart using this kind of categorization that make good sense to me anyway. And this is not my own theory, of course. Most of what I'm telling you today, it was stuff that I kind of accumulated from other people, but I first saw this kind of thing talked about in a book by Robert Miner called High Probability Trading Strategies. And his basic approach was to say, well, when you think of it, corrections are good places to get into markets. If I can identify that this is a correction and use technical tools to identify not only that it might be a correction, that it's just ended, then that's a great place to buy, because I can get in with a fairly close stop loss. If I'm wrong and the trend starts to head down again, I can get out pretty quickly. But on sometimes, at least when I'm right, then there's going to be a big move in my favor and I get that good payoff ratio. But even if the momentum's right, even in these circumstances, I tend to get a higher probability of a profit. So even if I'm looking for that higher success ratio strategy, there's a good chance of a good quick bounce in these circumstances that will get me a profit. That's one place to be. Another place is that if I can identify these accumulation patterns, and then once it's established, if I can buy down near the bottom of the accumulation pattern, then again, I'm in with a good chance of a good payoff in relation to the loss that I make if I'm wrong and it drops out the bottom end of it. Or alternatively, I might look at buying when I break out of the accumulation pattern, because again, once the market first breaks out of this sometimes that'll be the beginning of a big trend, and I can get in at the outset of a big trend, but again with a fairly small stop loss if it all rolls back over and down into the accumulation pattern. So a lot of what I'm talking about today when it comes to a technical analysis is that I'm looking for corrections, and I'm looking for them to end as a possible buy, or I'm looking for accumulation patterns as a possible buy. And if I'm trading CFDs and looking for shorting as well as buying opportunities, then I'm looking for corrections in strong downtrends and also for distribution patterns where I might be able to get in at the beginning of a large downtrend. And so lastly then, to set the scene before I get on to the sort of actual topic of combining technical and fundamental analysis, I thought it would be useful to talk about putting together a trading portfolio. Now, I'm not talking here about investment portfolios. In fact, I am going to do a webinar in a week's time on constructing an investment portfolio. But that's as with so much, investment is similar but not the same to trading. So, the sorts of things I've got on here on the slide are the kinds of things that you might begin to think about or to use as your overall architecture for putting together an investment portfolio. You're going to be beginning by thinking about your own circumstances, your wealth, your age, how risk averse you are and that sort of thing. And that will then determine, what mix of growth and dividend stocks you have, how much risk you want to take. It's always important with both trading and and investment to have risk management built into your portfolio, and a large part of that, of course, is diversification of the portfolio. And I'm not going to go into that today, but I just want to talk about that briefly to set up what I think are some of the differences with a trading portfolio. Now, the first thing about trading portfolio is that risk and that sort of stuff is important, but the key thing I think is that you're looking for stocks that fit your trading strategy, that fit the tools that you're using and are suitable for the kind of analysis you're doing. That's the sort of key message I've got here. And so just for valuation, for example, if I'm using a valuation kind of strategy, if I'm doing my own work on that, if I'm making my own assessments about earnings and forecasts and appropriate price earnings multiples and so forth, then I'd want stocks that I find easy to understand. For example, personally, I tend to steer clear of conglomerates with lots of different businesses in them. I like just nice, clean, simple businesses in one thing that are kind of, not too hard to fit together and to make work. But for many of us, and this is the approach we're going to be looking at today, where we're using other people's research to help with our valuation analysis, well, you want it to be supported by analyst research. So you can, you only want to trade stocks where you can get an idea of valuation based on other people's research. Even if you're doing your own research as a private investor, I think you still want analyst research. That's certainly my approach. It's very useful. You're not really worried about whether they think it's a buy or a sell, but it is great to get the insight of how other people are thinking about stocks, to think about the things that you've missed in your own thinking. To go back to this kind of approach, if I'm using this sort of thing where I'm, buying cheap and getting out at fair value not too far away, then I want my idea of the stock's fair value to be pretty close to the market's one. It may be that I think something's very cheap and the market's got it wrong, and that the thing's actually worth a lot more than I think it is. Well, that might be an appropriate stock for an investment, or for that big hit the ball out of the park, follow the trend, get involved in A2 milk scenario. But it's not an appropriate stock for that in and out kind of thing, because I'm trading there I'm looking for things that are fluctuating around a sort of a common idea of what the fair valuation would be. And so that's the kind of stock I'm looking for. The banks, for example, are a good example of that. They tend to do that, to sort of, you know, oscillate around a fairly standard value of idea of valuation a lot of the time. But I also I need to be very concerned with risk. Even though I might only be owning stocks a short time, I don't want to get involved in overly risky stocks. So I do want to consider gearing, management track record, the risk profile of the industry and so forth. And again, as we're going to look at today, there may be analyst tools that I can use to help me with that, or I can do it myself. Liquidity is an issue. I want to trade in stocks where, you know, there's a reasonable amount of activity, and that I know that I can most of the time get set by myself fairly easily with the kind of volume I'm doing. Now, for most of us private traders, particularly if we're looking at those big hit the ball out of the park strategies, this may not be too much of an issue, because, you know, at the end of the day with those kind of strategies, if I have to sacrifice a couple of cents in the bid offer spread, it doesn't really, you know, make much difference if I'm looking for the big A2 milk kind of scenario. It's a bit more important though when I come into those shorter term fluctuation kind of strategies. But generally speaking, you know, a lot of stocks for most private traders will be sufficiently liquid. You just want to make sure that they do have that appropriate liquidity. And diversification is also important for traders. You know, it's inappropriate to buy all four banks because they all suit your trading strategy, which they may very well do from time to time. You know, you've got to be appropriately diversified as a trader as well. For the hit the ball out of the park strategies, as opposed to the valuation ones, the same sorts of things basically apply. The big difference is though that you're more looking here for stocks, instead of stocks that are where your idea of valuation is fairly close to the overall markets. Here your main consideration may be charts that fit your strategy. Is this a nicely trending chart already that I can buy into corrections in, or is this an accumulation pattern that looks as though it could develop into a big trend? So to summarize all that, what I'm trying to say here is that as a trader, you need to be concerned with basic things like risk profile, liquidity, whether they're supported by research and valuation. But with the short-term valuation strategy, the key is for the valuations to be fairly close to the current market value. And for the longer-term trend-following strategies, the key is to use charts that look as though they fit your strategy and trading tools. And the last thing I wanted to say on this is you don't have to like the stock for a trading strategy. As an investor, you do, probably, I think anyway. You know, you want to own this thing for a long time. You want to buy stocks you like. Don't worry about that as a trader. You're looking for short-term fluctuations. You don't need to like them. And indeed, if you're also trading CFDs and looking to short, then it's a good idea to have stocks that you positively don't like, as well as ones that you do, because you're looking for selling opportunities as well as buying ones. Right. Well, the second half of the seminar now, I'm going to get onto this job of looking at combining technical and fundamental analysis. And I follow two basic approaches, two alternative approaches. You know, you can use them both, or you can use one or the other. The first overall approach is basically the idea where your primary tool is valuation. Your main idea is that you're looking for things that are, you think, undervalued, either a bit or a lot. And then you're using technical analysis as a secondary or supplementary tool. And its job then is to help you with your entry and exit levels to basically be an aid to where, if you think something is cheap, give you a hand at exactly where you buy and where you get out to either take your profit or to stop yourself out for a loss. The second approach, which I'll cover in a little while later, is where your primary tool is technical analysis. So you're basically about using charts, but you use fundamental analysis, a filter, to decide whether you're going to take a trade on a technical basis or not. So what are the benefits of technical analysis? Well, I think where technical analysis can add a lot is that, as we all know, I think, just because a stock is getting to a level that you think's cheap doesn't mean to say it's going to stop falling there. I think if you've had a bit of a go at stock trading, you'll be well and truly familiar with things where you might think something is good value at $2, at $10, but it goes on to fall to $8 anyway. And this is a situation, I think, for starters, where technical analysis can really be a big help. It stops you catching the falling knife, as the textbook classics say, and it basically gives you a better idea about when a stock that is falling and is already cheap might keep falling because it's just plummeting, or whether it's starting to set up and form a bit of a basis that gives you a better risk-reward point as an entry, and basically therefore creates a bit of a filter as to when you might want to take the trade. And so to just look at that kind of thing here, this is a chart. I put this part of the seminar together a fair while ago, but this is, say, that big support zone we saw in CBA, for example, the classic accumulation pattern. So, it had the bit of a buy zone here, and it was giving you this, idea that it might have been cheap here, but once it gets down to here and starts to reject that, you're getting that sign that it's beginning to flatten out at an appropriate level where you might want to get in. The second big job that technical analysis can do is to give you a failure point. That is a place to get out, because, as I've said on a number of occasions, trading is about profits and losses. It's very much about losses and about putting in place good strategies for when to take losses, and just as important as getting into good stocks and taking profits at appropriate places. And technical analysis, can set up a failure point. Now, what I mean by a failure point is that I think a very good idea, a basic strategic idea, is to say, well, the place I'm going to get out of a trade is the first place I can say that this trade has failed. Now, if I'm buying something because I think that it's just finished a correction and an uptrend is about to start, or it's just finished an accumulation pattern, or it's at the bottom of an accumulation pattern and an uptrend is about to start. If I'm doing any of that and the uptrend doesn't start, or the uptrend only goes a little way and then falls, and I start and we start making lower lows, then my strategy has failed. I'm not in an uptrend anymore. We're actually in a new downtrend, and that's the place to fail. And so technical analysis really helps with that. Here's the lowest low. So that's the obvious place to say, well, if it moves under there once I'm in, to begin with anyway, that's my failure point. If it moves under there with a little bit of tolerance, maybe then it's making lower lows. I'm wrong. That's where I get out. So those two key benefits in this situation, I think, for technical analysis, they help identify entry points by telling you, even though something is cheap, the trend might be about to change from down to up, and they help identify failure points where you're wrong and give you a place to get out. Okay, now, and to get on to our platform, there are a great many places, ways of valuing stocks, but I think there are some, a starting approach for the time poor is to look at available research and to play around with whether a other people's research can be a useful basis for your own strategy. Certainly, if it can, that will save you a great deal of time, and as part of saving a great deal of time, will make it much easier for you to apply your strategy to a wider range of stocks, which helps with diversification, but most importantly of all, increases your opportunity with a good strategy and lets you make more money. I mean, the traditional problem that we all have if we're doing our own analysis as private traders is that, you know, you really need to get into the DNA of a stock to understand it, and realistically that probably means, depending on your own circumstances, somewhere between about, say, 5 and 15 stocks as being the most that, you know, you can realistically handle. Whereas if you can find another way of doing it, that certainly widens that out. Now, so one of the things that I thought was a useful, for instance, of how to go about this is to look at the screener facility that we have available in our platform. Now, there's a number of ways to access that, but one is to use these tabs across the top of the platform here. That just gives a list of stocks that the screener has recently upgraded or downgraded. But other places you can see it. If you go to the main summary page, you will see a small summary of recently upgraded and downgraded stocks, and I'll come back to this at the moment. But if you go into each individual stock, you know, like Harvey Norman's the first one I just saw here, then each individual stock, if it's a big enough stock, will carry the screener's analysis. Question there by Mustafa. It's got nothing to do with the webinar, but I just noticed it and I will answer it. Do we have an accumulation pattern in the pound against the Aussie? I think yes, and in fact I did a blog on that a few days ago called 3 Chart Setups, and that setup is in there. So yep, I think there is a possible basic pattern there. Okay, so what's the screener all about? Basically the screener is this, it works on 4 stars, and those 4 stars say something about the following 4 things. One is valuation, and one of the reasons that attracted me to looking at the screener is that it uses a price earnings to growth ratio as the basis of their valuation, except they do it backwards. So it's sort of based loosely on the price earnings to growth, and I think that's quite a useful tool because it relates a company's current valuation in terms of price to earnings with its growth prospects, which is often a pretty useful thing to do. Now, they do theirs sort of backwards, really, and basically the way they've done things is that a high ratio, or one of their ratios, means that something is good value and vice versa. And they use a system of arrows, green arrows for something that's cheap or in a good valuation range, and red arrows for something that's basically expensive. Their second star relates to earnings revision. That is, have analysts been upgrading or downgrading their earnings forecasts for this stock over the last 7 weeks? Their third star relates to relative performance. How has this stock performed relative to the main index in recent times? And their fourth star relates to technical trend. So whether basically the prices increased or decreased relative to a certain reversal point that they use in recent times. And if it's within, I think 1.75% of that, they regard that as useful. So now, here's a basic approach to strategy using the screener. Now, the standard way of using a screener is to use their 4 stars, I think, and to say, well, look, something that's got 4 stars is in a positive mode. I'm not going to do that here though, because I'm myself using my own technical tools, and I also am not very interested in their momentum, because remember, my basic idea is that I want something that's value, that's something that's just become cheap, or is becoming, or is in a downtrend and starting to reverse, that's dropped into my value zone. So a lot of the situations that I'm looking for are going to have sort of bad momentum, according to the screener. And secondly, I'm also, for the similar reason, not really interested in their view of technicals, because in the strategies that I'm looking at here today, I'm combining my own technical analysis with valuation. So the strategy here is that, firstly, I'm only interested in a stock that fits all the trading portfolio rules that I've set up about liquidity, risk, appropriately supported by research, and so forth. When it comes to risk, though, the screener does provide a risk tool, and so one thing to consider is to use them for risk. And if you look, we'll look at the platform in a moment, they have this little risk thing here where this one's neutral. Over here, they've got, is in the good sort of low risk category, but over on this side, when it goes red, is high risk. So one basic idea to save time would be just to use them and say, look, I'm not going, if the stock is in their red risk zone, I don't consider it for a trading strategy. It's not in my portfolio. Next, I'm going to use them for valuation. So their best valuation rating, the things that they're looking at, is best in terms of price earnings to growth, or their version of it. Get these two green arrows. So my core strategy is, does it fit my portfolio rules? Is it neutral or good risk as far as the screen is concerned? Does it have two screener valuation ratings? And if the answer to that's all yes, then I'm looking for technical analysis to provide me with a setup, something that might be at the end of a correction, or coming out of the bottom, or breaking out of an accumulation pattern. That sort of thing is my basic, would be a basic straightforward strategy using this combination technique and the sort of overall thing that I've outlined here. So let's just have a look at a few examples of that. Now, as I say, this can't be a webinar really about technical analysis. We don't have time for that. But firstly, I just went through that page that we looked at before, over here in the screener tab. I could go to Tools, select the screener, and I simply went through all the stocks here with appropriate risk and double green arrows, and then looked for charts that I thought were interesting. And so the first couple of 2 or 3 examples I've got, that's what I've done. Now, Southern Cross Media was one of those. And basically the situation with these stocks is it's using one of these AB equals CD patterns. That's one of the trading strategy, technical strategies that I employ. The reason I employ it is that it's a strategy that tells me when something is correcting and when that correction might be ending. And here we are with Southern Cross Media, where I've used the Fibonacci retrace extension tool. I should go into the platform to show these. I'm sorry, I'm getting myself confused here. That was my intention, to give you a better look at how all this works. So let's go in now to Southern Cross Media. Now that I'm in the stock page, I can go to the advanced chart function up here, because I think our charts on this stockbroking platform now, I believe, are really good. You know, basically got all the essential tools that you might want to use, and are very easy to flick through a lot of charts and time efficient. So what I did here was I went to the Fibonacci tools over here. I selected the Fibonacci expansion tool, and I've just clicked there on the beginning of this trend, which is the AB part of it, then gone to the beginning of the trend that I want to extend out, this part here, and that's telling me 100%. That's saying that this trend is currently the same size as that trend. So now if this gets rejected, then that's my setup. So it's got everything: 2 screens, 2 arrows, risk, technical setup. I've got a failure point. If I'm wrong, the market will move under this low here, and that's the place for my stop loss. Now with this one, sort of thing that stock traders do have to take into account all the time, particularly after the reporting season, you need to be very conscious of the ex-dividend season. Now, I went and had a look. Now, this stock goes ex-dividend tomorrow, loses 4 cents. So today is not a good day for this, because this is going to trade ex-dividend tomorrow, ex 4 cents tomorrow, and is probably all else going to come down here. But it does potentially, though, bring the next level of this down here at the 121 level. So actually, I'm sorry, this is the 100. And what I should say here is I won't take too much time up, but I can edit these things. I use 127.2 as well as 100%. So if it was to fall down here after it goes ex-dividend tomorrow and reject that, that would be my setup. Another example in that list, I won't go back to the list, but one thing I did want to show was that an easy way of scrolling through these charts on the advanced chart, once you've got it open, is to set up watch lists, and then if I just click on any stock I've got in my watch list, it immediately brings that chart up, so I don't have to keep on then flicking around between different stocks in the actual platform. I can just easily bring up different stocks. Now, this to me, the reason I've got this chart here is that this looks as though we might have a small time accumulation pattern starting here. I often use divergence as a reversal trader with momentum indicators. So if I was to go in here into the studies, excuse me again, I'm sorry about this. And look for the relative strength index. I'm going to amend that because I use 14 periods, which is the standard period for daily stock trading, and I'll set that to my default. And what attracts me to this situation is I've got the classic divergence going on here, that we've got still making lower lows in price, but we've got the RSI starting to make higher lows, and it's broken out above the 30% or oversold zone. So that's, remember I was talking about value, trend, and momentum. So here we've got trend possibly in an accumulation, momentum showing falling downward momentum or even rising or commencing upward momentum, and value, because this has the 2-star arrows that the screener says is a good value opportunity. And now my setup, for example, might be to just look at this resistance here, and from here, if this accumulation is confirmed with a break above it, that would be my buy. Or alternatively, if it drops back here and sets up again, rejects this, I might get an opportunity to buy off the bottom of the accumulation pattern, which is even better risk reward, of course. And that's the basic approach. And, you know, if neither of those things happen, just drop straight down here, there's no setup. But if one of them does, then I've also got the failure point there. Another example on the list here was BWP, which is the real estate trust that owns Bunnings warehouses. And I've already done this one. I've saved my work here. Well, I can do that by using this, setting up presets. I use different time frames, daily, monthly, daily, weekly. I set up my different charts so I can easily flick between the three. And then once I've done some work on it, if I update the setting, it will save that work for me, so I don't have to keep on redrawing it. So here's a nice accumulation pattern, I think. This has got the screener's two valuation ratings. If it happens to drop down here again, and reject it, there's another buy opportunity. My failure point is down below this lowest low. Potentially, though, if it breaks out of the accumulation pattern to the upside, that might be another setup consistent with my overall architecture with a failure point then possibly down below this recent low back inside the body of the pattern. I just wanted to demonstrate, though, that you don't just have to use only the stocks on that screener page. Another very common alternative, of course, is that stock traders will have a set of stocks that they trade. Might be 5, might be 20, might be 30 that they know a bit about, that they like, that are sufficiently liquid for them, and so forth. And you can just follow those stocks and go to their individual page to see how they fare with the screener, and then apply your technical analysis. So using that sort of analysis, I might be looking at, say, Woodside, which is not on that screener page at the moment, because bearing in mind that that page only has recent upgrades and downgrades or to the screener stars. But if I was following Woodside anyway, I won't go and show you now, but you go to Woodside's page and look at the screener, you'll see it's got two valuation ratings, and it has a neutral risk rating, so it fits my criteria. And I think it's just set up an accumulation pattern by bouncing off this support now. So that's the setup now. We've got the clear failure point, and you'd either be buying in here now, or alternatively waiting for it to come back and again reject this support potentially. Lastly, another one here on the screener list was Bapcor. Now this stock is the old, I forgot what it used to be called now, but it's a changed its name, and at Burston, I think it was Burston, yep, and it was it's an automotive stock. Now I just wanted to put this one in. It was on that list. This looks to me like a possible long-term triangle situation, this pattern, and it does seem to be possibly confirming a support line here. Now, it's quite a long way away, though, but I put this in just to illustrate the fact that with stock trading particularly, patience is a virtue. This is a situation where you might be watching this for weeks or months before it returns to this support line, if indeed it ever does. And then when it returns to it, it's got to reject it, or start to sort of show signs of rejecting it to be a setup. And that may not happen, but the idea though is that you have these things on your watch list, and you just keep on keeping an eye on them, and that will throw up opportunities for you. And once you've identified the possible opportunity, it's quite easy, particularly if you're using this watch list technique, just to quickly scroll through all the charts you've got on your watch list, to keep a bit of a daily eye on them, and when they get close, to get a bit more active in your monitoring. And that's the sort of way that you can use technical analysis quite efficiently to expand out your trading techniques. All right, and then just to finish off, in the few remaining minutes we've got, I just wanted to take a quick look at the alternative approach. So that whole segment I've been talking about there, just to sort of recap, is about where my fundamental and basic approach is to identify stocks that are cheap, and then to use technical analysis to help me identify an entry and exit rule. Here, I'm looking at precisely the opposite, but also a valid way of combining technical and fundamental analysis in my view, and that is to say, well, my primary technique here is to identify chart opportunities, but then to use the valuation as a filter on whether I'm going to take these trades or not. Now, I've personally found this to be a really useful filter. I must say my own experience has been that technical buy setups do work on average a lot better when stocks are in a good valuation zone, and not nearly as well when they're getting into the expensive zone. And so the basic idea here is, again, your beginning point is you're looking for stocks that fit your portfolio rules on liquidity and so forth. You want them to have appropriate risk profiles. You're never going to buy any stock that is too risky for you, so you might use, for example, the screener to help you with that. Then you're going to, the second thing is you're going to be looking for stocks that have, are correcting or ending a correction that might be a buy point, using my basic outlook, or in an accumulation pattern. But you're going to reject them if they've got red screener valuations, either 1 or 2, because that's the screener saying they're expensive in their, according to their methodology. So you're just going to let those ones go through as a keeper and not buy them. There are usually plenty of opportunities, and this sort of thing is aiming at improving your success ratio in particular, getting that ratio of winning to losing trades higher. It will, of course, keep you out of plenty of trades that go on to be winners. That's the nature of trading, isn't it? You're aiming at probabilities over time. So any filters, you know, there are going to be plenty of times where you say, you know, I've been sweating on that chart. It hit my level. It rejected it. Everything was perfect. It's going to make a fantastic profit, but I didn't get into it because the damn screener kept me out of it. Of course, that's going to happen a lot of times. But if this technique's going to work, it will save you more losses than profits it costs you, is basically what you're talking about. So you will take trades that have got green arrows or a circle that the screener's got in a neutral valuation, prepared to maybe take neutral value stocks because basically your key technique here is a trend, and this is probably the technique where you're looking for the big payoff ratios, wanting to get set in the big CSL, A2 milk, Domino's pizzas type situations. So just to look at a couple of examples here, and let me go back now to the platform to do this. So one that I've got on the watch list is Domino's, which, as I'm sure most stock traders will be aware, has been beaten up rather badly in recent times. They're coming from $80 odd down to $40, or halving in value, but in the process now does have one screener green valuation arrow. So is a permissible stock for me to look at buying, and also is in their neutral value. Now, what I'm looking at here is one of these ABCD things using the Fibonacci tool again. I'm using here the expansion tool, and what I've done is to look at 2 trends. Firstly, this big one here. So I'm grabbing that distance, that first big run down, and replicating it from the start of that high there. And you can see that the 100% the A to B, C to D equivalent point, I did that incorrect, there might be better, is down here at about $38.50. But also, if I look at this minor one here, looking at this trend and grabbing that distance with the tool from this starting point and looking at the 127, which is what the other one that I use. If I had more time, I'd just put that 127 in as a default, but I won't worry about that. Now you can see that the reason why that was showing incorrectly to begin with is that I had the wrong starting point. But as you can see, that comes in at about a similar sort of level, just about 38 bucks or so. Indeed, let's move that up there. And so I've got this zone in here, 38 to 38.50, and you know we may or may not hit that, but there I've got a possible level where if it hits that and starts to reject it, that's a buy level that I'm happen to be looking at, and I've got valuation filters that support it. On the other hand, though, if I go in here and look at Blue Scope Steel, and to save time, I won't do this, but if you go in to look at Blue Scope Steel's page here on the platform and look at what the screener has to say about it, you will see that the screener's got a red arrow for Blue Scope. So now I might otherwise have been looking at this trend line coming up here. We're getting fairly close to that, and we might be hitting that trend line at a time when it's oh no, we're not. No, I'm sorry about that. Let me delete that thought bubble. Keep things simple. So, you know, we may be looking at this trend line here, but even if we hit it and reject it, unless the screener changes things in the meantime, I'm not, you know, my filter process does not allow me to take this trade because it's got a red valuation arrow. So I'm going to let that one go through to the keeper. So that's an example where my primary tool is technical analysis, but I'm using valuation as a filter, and unless value is neutral or cheap, I'm not going to take the trade. And indeed, if I was a CFD trader, I might actually be considering shorting this if it broke that that trend line resistance, or at least having broken it, then maybe looking for corrections that I could sell into after that was done. So that was it, ladies and gentlemen. It concludes what I wanted to say. I'm certainly happy to hang on for a moment or two to answer any questions anybody may have. I can see here there is one question asking about Telstra. Let me go in and have a look at the Telstra stock and see what the screener has to say about it, shall we, to begin with? So the screener gives it a valuation arrow and a neutral risk zone. So potentially this would be a stock that, you know, that I may consider buying if I got a correction in an existing uptrend or an accumulation pattern to buy into. Now, knowing what's going on in Telstra at the moment, I don't expect to see anything that looks like an accumulation pattern. At the moment, we've seen it been gapping around. Basically, you know, it's in this downtrend. It is rallying at the moment, so it is making higher highs and higher lows, but that's looking like a correction against an ongoing downtrend. So this is an example of what I go right back to at the beginning. So let's say you think Telstra's getting cheap, but technical analysis is helping you possibly from catching a falling knife. Now, again, technical analysis is going to keep you out of some things that would have been profits where you might have caught the falling knife successfully, but as this stock currently stands, you would be wanting some sort of, or I would be wanting, according to my strategies, some sort of basing pattern to begin developing before I thought about taking advantage of the fact that it's getting cheaper. Okay, ladies and gentlemen, one question there, will this be available for later reviewing? Yeah, look, it won't be in the near future, but we will look at getting a recorded version done at some time in the future. And so, Jeff, we've got your email details here in terms of registering. So when we get one done, I'll be happy to make a recorded version available to you. Now, a great question from Dick here. When do I sell if I'm making a profit on a trade? Now, that's something I meant to say. I didn't go into that today because there wasn't time, but let me just go right back to this general point that I was making previously. Which is that I think there are two basic kinds of approach. So one is where you're aiming to have, a good success ratio, probably 60%, certainly well and truly north of 60 to 70+%. So there you're looking to take profits fairly quickly. So one approach I would have with that basic approach is I have an idea of where I think something's cheap, and I have an idea of where I think it's fair value. Now, I probably can't use the screener for that because they may not be sensitive enough, but I might have my own value. Certainly, this is was my core strategy as a professional trader, and I'd be buying when it was cheap, using charts to help me with my entry, selling it when it got back to fair value, except I'd use charts to help me with where that was. So if the chart was telling me actually there was resistance a bit south of where I thought was fair value, then I'd be seeing whether I could make the trade work on a risk-reward basis by selling a bit before. Or if the chart was telling me the resistance was up somewhere north of my idea of fair value, then I'd be prepared to run the chart up to that resistance. One basic approach. On the other approach, where my core strategy is chart trend following, where I'm looking for the big, staying with the A2s, A2 milks or whatever. They're my basic. I use valuation to get in, but I'm going to stick with it whilever the trend sticks with it. So I'm going to be using charts as my thing that tells me where to get out. And what I'm particularly going to be doing there is looking for something that tells me the trend is ending, to get out. Because if I'm going to get into that big momentum trade, that if I'm going to buy, CSL when it's cheap and stick with it, the chances are that it's going to get to a valuation that I think and the screener thinks is probably pretty expensive. But I'm going to stick with it anyway, wherever the chart tells me the trend is going. So I don't have time to go into details, but that's the basic sort of approach to it. No trouble, Anthony. Got that, thanks. Okay, well, thanks for joining us today, ladies and gentlemen, and we'll call it stumps there. But just a reminder that we've got a series of these going on in the course of the next few weeks.